Hi there, I'm Sup Day. I'm a chartered accountant and I'm hoping to do some tutorials in financial accounting and reporting, and this might help students who are sitting for accounting examinations. This tutorial is about accounting for revenue. Questions on revenue recognition and measurement is always tested in professional accounting exams. Revenue is the most important item in an entity's income statement for the following reasons. Revenue is a key performance indicator. It indicates whether an entity is growing or contracting. Revenue is a valuation metric for entities. The value of a company can be expressed as a multiple of its sales or revenue. Misstatements of revenue is a common fraud occurrence by management because of its direct impact on the company's share price and directors' compensation schemes. And finally, in recording revenue, there are recognition and measurement principles which require the exercise of judgment. The accounting for revenue for students is a lengthy and complex topic. So in tutorial 1, we will discuss the revenue recognition and measurement principles and the accounting issue arising from their application. And in tutorial 2, we will then go on to the other areas of revenue accounting, which is accounting for warranties in sales contracts, accounting for sales returns, repurchase agreements included in sales contract, and finally, principal versus agent considerations in sales contracts. IFRS 15 adopts a 5-step approach to revenue recognition and measurement. Step 1 is to identify the contracts with the customer. Essentially what has been agreed between the customer and the entity regarding the product service offering and payment. Also, an assessment of collectibility is included as one of the criteria for determining whether a contract with the customer exists. Step 2 is to identify the separate performance obligations in the contract. A performance obligation is a distinct promise to transfer goods or services to the customer. Step 3 is to determine the transaction price, i.e. what has been to be paid by the customer. Step 4, allocate the transaction price to the performance obligation. And finally, step 5 is to recognize revenue when or as a performance obligation is satisfied, and this could be at a point of time or over time. We'll now consider some of the accounting judgments and issues that arise when applying the revenue recognition and measurement principles to sales contracts. The first area of judgment is determining the number of performance obligations in the sales contract. Number 2, another area of judgment is determining the transaction price, i.e. what the customer will pay, where the revenue consideration payable by the customer is variable, i.e. not fixed. Then accounting for any financing component included in the sales contract. And 4, where revenue is recognized over time, how do you calculate the portion of the revenue to recognize? There are accounting judgments when applying the revenue recognition and measurement principles. But let us first review what that recognition principle is. An entity shall recognize revenue when the entity satisfies a performance obligation by transferring the control of goods and service to a customer. So the keywords are performance obligation and control. Control here means there are many indications that control has passed to the customer. This is where the customer has an obligation, a present obligation to pay, gets physical possession, gets legal title. the risk and rewards of ownership has passed to the customer, or has finally accepted the goods. Let's look at now the first area of accounting judgment, which is determining the number of performance obligations in a sales contract. A sales contract or revenue transaction can have more than one performance obligation. Example, a sales contract for the supply of equipment and its installation can be viewed as two performance obligations. The general principle is that any goods or services that provide a distinct and separable value to the customer typically would be recognized as a separate performance obligation. Usually, this would be evidenced by each performance obligation having a standalone selling price. Let's look at an example of a revenue transaction with more than one performance obligation. On 31st of March 2021, XYZ plc sold a large machine and an after-sales repair service for 2 years to 31st of March 2023 to a customer for £840,000. The standalone prices for the machine and after-sales service is £800,000 and £160,000 per annum respectively. XYZ plc estimates that the after-sales service would cost the company £50,000 per annum and have incurred expenditure of £20,000 to date. Required, explain and show how the revenue transaction described above should be accounted for and reported in the financial statements of XYZ plc for the year ended 30th of September 2021 under IFRS 15. Solution. Identify first the separate performance obligations. Now there are two performance obligations, the sale of the large machine and the after-sales repair service for 2 years. Both performance obligations have standalone prices. Calculate the discount given, and this is the difference between the sale price of £840,000 and the total of the two standalone prices of the performance obligation of £960,000, which is the £800,000 plus the £160,000. Apportion the discount proportionately to the two performance obligation. Recognize as revenue when each of the performance obligations are satisfied. So the revenue from the sale of the large machine will be satisfied at a point of time, that is when the delivery of the machine takes place, and the revenue from the after-sales service will be taken over time and allocated on a straight line basis. The question requires us to show how the revenue transaction should be accounted for and reported in the financial statements of XYZ plc for the year ended 30th of September 2021. We have to start with the workings first to show how the transaction prices are allocated to the two performance obligations. So you got the selling price of the machine, or the standalone price of the machine is 800. The after sales standalone price is 160. Together we have 960, and the actual customer sales price is 840, which suggests that there is a discount of 120. We break that into percentages and we get 12.5%, and we reduce both the selling price and the after sales service by the amount of the discount. So we've got 700 for the selling price of the machine, and the after sales service works out at 140, and together we get the amount that the customer is paying, which is 840. Now we next look at how we're going to report that in the financial statements. Start with the profit and loss account. The revenue is 700. The after sales service for 6 months, which is 140 divided by 4, okay, gives us 35. And for the year to 30th of 9, 2021, it's 735,000. The cost of sales is what the company has spent so far to date, which is the 20,000. And we come to the balance sheet next. We've got the total deferred liability, right, which is 105, which is 140 divided, take away 35 for the current year. We then have to split that 105 into the current deferred liability and the non-current. So the current deferred liability is 70, and for the non-current is 105 minus 70 gives us 35. Next accounting issue is to look at how we ascertain the transaction price in the sales contract. Determining the transaction price where the revenue is variable or subject to a constraint rule, for example, goods sold with a right of return, or where the price of the goods sold is dependent on the volume of units sold. Sales revenues which are subject to a constraint rule are referred to as variable consideration. An entity shall estimate an amount of variable consideration by using either of the following methods: the expected value method or the most likely amount, and take a prudent approach. So the expected value is the sum of probability weighted amounts in a range of possible consideration amounts. The most likely amount is the single most likely amount in a range of possible consideration amounts. Let's look at an example of a sales contract with a variable consideration. The price of in the sales contract specifies that each pack of cigarettes is sold for £10, with a rebate being offered at the end of the contract based on the total number of packs sold. Here we look at the kind of rebate you would get depending on the volume. So if it's between 1 and 1,000 packs, you get £10 a pack. If it's between 1,001 and 1,500, the price per pack drops to 8. And if it's more than 1,501, the price drops to 7. Now, if the entity's financial year end is before the end of the sales contract, the entity shall estimate the rebate using the expected value method or the most likely amount. Now let's look at an example of a sale with a volume discount incentive. On 1st of January 2019, Delta began an arrangement to sell goods to Entity B with a volume discount incentive. The price of the goods was set at £100 per unit for all sales in the 2-year period ending 31st of December 2020. However, if sales of the product to Entity B exceed 60,000 units in the 2-year period ending 31st of December 2020, then the selling price of all units is retrospectively set at £90 per item. Sale of the goods to Entity B in the 9-month period ending 30th of September 2019 totaled 20,000 units, and this volume of sales per month was not expected to change before 31st of December 2020. However, in the year to 30th of September 2020, total sales of the good to Entity B were 35,000. The directors of Delta now estimate that the total sales of the goods to entity B in the 2-year period ending 31st of December 2020 would be more than 60,000 units. Required, explain and show how the transactions would be reported in the financial statements of Delta for the year ended 30th of September 2019 and 2020. Right, solution. First, the consideration payable by the customer is a variable consideration as it depends on the volume of sales in the 2-year period. At 30th of September 2019, Delta can reliably estimate, assuming that the sales of the units per month doesn't change, the volume discount threshold will not be exceeded over the 2-year period. And we got that by the 20,000 units that was sold in the 9 months, and we multiplied by 24, and when we extend it, it comes to 53,333 units. The revenue included for the year ended 30th of September 2019 would be booked at £100 per unit and would be 2 million, which is 20,000 units times 100. At 30th of September 2020, the cumulative units sold is 55,000. That is the 20,000 plus the 35,000 units to September 2020. Now the directors expect that the cumulative units sold by 31st of December 2020 to exceed 60,000. The selling price of all units will now be retrospectively set at £90 per item. This means that the cumulative revenue relating to these goods at 30th September 2020 will be 4.95 million, which is 20,000 plus 35,000 times 90. The revenue booked by Delta for the year ended 30th of September 2020 will be 2.95 million, which is the 4.95 million minus the 2.2 million recognized in 2019. The next accounting issue we're going to look at is the accounting for any financing components in a sales contract. The entity has to adjust the amount of consideration paid by a customer at the contract inception for any significant financing component where the delivery of the goods or services takes place more than a year after. The objective of adjusting the promised amount of consideration for a significant financing component is for the entity to recognize revenue at an amount that reflects the cash selling price of the goods or services. In the next slide, we will consider a sales contract with a significant financing component. We'll now look at an example of a sales contract with a financing component. XYZ PLC builds apartment blocks which normally takes 2 years to complete from the date of signing the contract. The title and possession and therefore control of the apartment block passes to the customer upon completion of construction. The price which is payable on completion of each apartment block is 9.55 million. Alternatively, the customers can pay 8.5 million cash on the day the contract is signed. The chief accountant has calculated that this represents an appropriate borrow rate or discount rate of 6% for XYZ PLC. XYZ PLC immediately recognizes 8.5 million as revenue if the customer pays when they sign the contract. Required. Discuss whether XYZ PLC criteria for the recognition of revenue is consistent with IFRS 15. So let's look at the solution. First, IFRS 15 states that the revenue is recognized only when the performance obligation is satisfied. And that happens on the date the construction is completed, which is also when the title, possession and control of the apartment block passes to the customer. And this will happen in 2 years' time. The contract also has a significant financing component. The advance payment of 8.5 million represents the discounted cash price of the apartment of 9.55 million in 2 years' time at 6% interest. Therefore, XYZ PLC's recognition of 8.5 million as revenue now when they signed for the contract is incorrect. XYZ PLC should recognize a contract liability of 8.5 million and should subsequently accrue interest on that liability balance for 2 years until it reaches 9.55 million when the performance obligation will be satisfied. Further, IAS 23 borrowing costs, paragraph 10, states that the borrowing costs that are directly attributable to the acquisition, construction and production of qualifying asset form part of the cost of that asset and therefore in this case should be included in the cost of inventory production, i.e. added up to the cost of the building. In the next slide, we will show how the accounting entries to record the contract sale. Now we look at the accounting entries for a sales contract where there is a financing component, i.e. payment is received from the customer prior to the completion of the apartment. Start with the journal entries. We received the cash in year 1 of 8.5 million, we debit it, and we credit contract liability in year 1 of 8.5 million. At the same time, the 8.5 million represents the present value of 9.5 million receivable in 2 years' time, discounted at 6%. Under IAS 23, the interest cost can be added to the cost of the building. So the interest cost is 6% of 8.5 million is 0.51. That is added to the cost of the building, or which is treated as part of inventory. And the contract liability account is credited with 0.5 million. In year 2, we calculate again the interest cost, which is 6% times 8.5 plus 0.51, and that gives us 0.54. And we then credit the contract liability with 0.54 million pounds. Finally, in contract liability in year 2, we will debit with 9.55 to clear the account, and the revenue will be credited with 9.55 million. The next accounting issue relates to revenue recognized over time. For revenue to be recognized over time, the following criteria must be met. First, the customer simultaneously receives and consumes the benefit provided by the entity. For example, the provision of TV services where the delivery and consumption takes place simultaneously, hence revenue apportioned over time using the output method. The entity's performance enhances or creates assets that the customer controls. Example, the entity constructs a building on land controlled by the customer. And finally, 3, the performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. For example, where the entity provides goods or services that are specifically tailored to one customer and the entity must have an enforceable right to payment. So what is the accounting issue? Where revenue is recognized over time, how do you calculate the portion of revenue to recognize? IFRS 15 suggests 2 common methods for measuring work in progress or progress to date. First the output method that recognizes revenue based on direct measurement of the value transferred to the customer. Example, units delivered and milestones reached. 2. Input methods. The revenue recognized based on the reporting entity's cost to date as the proportion of total cost to satisfy the performance obligation. Now look at an example for accounting for contracts where revenue is measured over time. Associate Solutions Limited is building a bespoke software system for an insurance company. The contract started on 1st of January 2017 with an estimated completion date of 31st of December 2009. Details of the contract. The contract price is $2 million. The total expected cost is $1.2 million. The cost incurred to date amounted to $0.8 million. Value of work certified to date is $1 million. It is estimated with reasonable certainty that further cost to completion will be $0.4 million. So if you add the $0.4 million with the cost incurred to date, you get $1.2 million. So effectively, they are within budget. And so the question is, if the company's financial year ends on 31st of December 2017, calculate the contract profit in 2017 using both the input and output method of measuring completion. So let's look at the input method first. Now this is a contract in which the performance obligation is satisfied over time, and reason is that the entity has an enforceable right to payment for work completed to date. And we can see this from the fact that certificates of work of completed work has been issued. When the stage of completion is calculated using the input method, costs recognized in the income statement is the contract cost incurred to date. Profit is calculated based on the percentage of completion of the contract. So the percentage of completion of contract based on cost is 0.8 million divided by the total cost of 1.2 million times 100, and you get 66.7%. We apply then we calculate the profit on the whole contract, which is 2 million minus 1.2 to give us 0.8 million, and we apply that percentage in terms of the profit we are going to take into 31st of December 2017, which is 0.667 times 0.8 million to give us 0.53 million. Now, revenue recognized in the income statement is the balancing amount arrived by adding the cost and profit. So we've calculated the cost to be 0.8 million and 0.53 is the profit element to give us a total figure of 1.33 million. Now, income statement for 31st of December 2017, and we can input these figures. The revenue is 1.33 million. The contract cost is 0.8 million. The profit is the difference between the two, which is 0.53 million. And so far as the balance sheet is concerned, the contract asset amount will be the contract cost to date plus the percentage of profit to date, which gives us 1.33 million. We're not told that any of this amount has been invoiced, so none of this is classified as receivable. Now we're going to look at the same example, but we're going to use the output method of accounting for calculating profit. So under the output method, the entity is entitled to revenue that corresponds to the amount of work certified to date. So it's 50%, and we work that out by dividing the work certified to date, which is 1 million, divided by the total contract price 2 million to give us the percentage figure of 50%. So the profit on the whole contract is 800,000, and we work that out by the contract price of 2 million minus the given figure of total expected cost of 1.2 million, and on the basis of that we can take 50% of that profit, which is the percentage of profit based on the output method, and that gives us 400,000. Now the difference between revenue and profit will represent the cost to be charged in 2017 under the contract cost. So that gives us a figure of 600,000, which is 1.2 million minus 0.4 million. The difference between cost incurred to date of 800,000 and cost charged to the profit and loss account of 600,000, which gives us 200,000, represent costs still to be recovered from the client. So let's input all these figures to the income statement and see how we work out the profit. So revenue is 1 million, that represents the work certified to date. The cost of the contract based on the output method that can be charged to 31st of December 2017 is 0.6 million, and the profit to date is 4 million. In the balance sheet, the contract asset amount will be the cost of contract plus the profit to date plus the cost not yet charged to the client, and that is 0.6 million, which is the cost of the contract in the financial statements to 2017, plus the profit of 0.4 million, plus 2 million, which is the cost not yet charged to the client, and that gives us a figure of 1.2 million. Again, we are not told that any of this amount have yet been invoiced, so none of this amount is classified as receivables. In the next tutorial on accounting for revenues for students, we will be looking at accounting for warranties in sales contracts, accounting for sales returns, repurchase agreements, and principal versus agent considerations in sales contracts.